Welcome to this trading lesson. Today we are going to explore a powerful strategy that can really help you level up your trading game. By the end of this session, you will understand how to use range charts to spot important opportunities and improve your trading skills. So stay with me because we have a lot of great insights coming up. Imagine being able to filter out all the market noise and focus only on the most meaningful price movements. That is exactly what range charts allow you to do. Let us begin by talking about what a range chart really is. A range chart is a type of price-based chart, and here is the important part. Each bar represents a specific price movement instead of a time interval. That means new bars form only when the price moves by a certain amount. It does not matter whether that price movement happens in 1 hour or 1 day. This kind of chart is all about focusing on significant price action. It filters out small movements that do not matter much, making it easier to see clear trends. And when you see those trends clearly, you are in a better position to find trading opportunities. Range charts are especially useful for identifying several key chart patterns that can help you make informed trading decisions. One of the most common patterns is the *** double top ** or ** double bottom **. A double top occurs when the price reaches a high level twice but cannot break above it, indicating potential downward movement. A double bottom is the opposite. The price hits a low level twice and struggles to move lower, often signaling a potential rise. These patterns are easier to see on range charts because the noise is filtered out, making the support and resistance levels stand out. Another powerful pattern to look for is the ** head and shoulders ** pattern. This pattern typically indicates a reversal in trend and consists of 3 peaks: a higher middle peak, the head, and 2 lower peaks on either side, the shoulders. The neckline, drawn through the base of the 2 shoulders, acts as a key support or resistance level. When the price breaks through the neckline, it often leads to a significant price movement in the direction of the breakout. Range charts make these patterns clearer by focusing only on substantial price changes, allowing you to identify these opportunities more effectively. Also, keep an eye out for ** flags, ** and ** pennants, **. Flags are small, rectangular patterns that form after a strong price movement, often signaling a continuation in the same direction. Pennants are similar but are shaped like small triangles. Both patterns represent a pause in the market before the trend resumes. Identifying these on range charts can give you great entries for trend continuation trades. Another useful pattern is the ** triangle pattern **, which can either be ascending, descending, or symmetrical. Ascending triangles are characterized by a horizontal resistance level and a rising support level, suggesting a breakout to the upside. Descending triangles have a horizontal support level and a declining resistance level, often signaling a breakout to the downside. Symmetrical triangles, on the other hand, indicate a breakout could happen in either direction. Range charts help to define these triangles clearly by removing the distractions of time-based fluctuations. By understanding and identifying these chart patterns on range charts, you can significantly improve your ability to predict future price movements. It is all about recognizing the repeating formations that indicate shifts in market behavior. Sounds interesting, right? Keep listening because we are just getting started. Now you might be wondering, how do we actually set up a range chart for trading? It starts with choosing the right range size. The range size decides how much the price has to move before a new bar forms. You can make the range smaller if you want to see more detail, or larger if you want to focus on big price moves. For example, if you are trading a stock that costs around $100, you might use a $1 range size. That means a new bar will form every time the price changes by $1. For assets that are more volatile, you could use a larger range size, maybe $5. It all depends on the asset you are trading and its volatility. Choosing the right range is key, so keep an eye on the movement of the asset and adjust the range until it makes sense. Moving on, one of the most important skills you can develop is learning to identify key patterns with range charts. Range charts are excellent for making trend lines easier to see because they are not cluttered by small price changes. You can draw trend lines along the highs and lows to see the overall direction of the market. Breakouts become much easier to spot since there is less noise compared to time-based charts. You want to look for price breaking above resistance or falling below support. Those are usually the moments when you get the best trading opportunities. Support and resistance levels are often much clearer on a range chart, which is great for deciding where to enter and exit trades. Let us discuss some additional chart patterns that are valuable when using range charts. One key pattern is the *** triple top *** or *** triple bottom ***. A triple top is when the price hits a high level 3 times without breaking through, indicating a strong resistance level and potential downward movement. A triple bottom, on the other hand, occurs when the price reaches a low level 3 times but cannot move lower, often signaling a potential upward reversal. These patterns represent a stronger confirmation than double tops or bottoms, and are easier to identify on range charts due to the reduction of market noise. Another important pattern to watch for is the ** wedge pattern **, which can be either rising or falling. A ** rising wedge ** forms when both the support and resistance lines are moving upward, but the support line is steeper, suggesting that upward momentum is weakening. This often leads to a bearish breakout. Conversely, a ** falling wedge * occurs when both lines are moving downward, with the resistance line being steeper, indicating a potential bullish breakout. Range charts make these wedges more obvious, helping you to spot possible reversals or continuations earlier. The ** rectangle pattern * is another formation that can be highly useful. This pattern forms when the price moves between a horizontal support and resistance level, creating a range-bound market. Traders can buy at the bottom of the rectangle support and sell at the top resistance until a breakout occurs. Range charts help you identify these consolidation phases more effectively, providing opportunities to trade within the range or prepare for the breakout. Do not forget about **, cup, and handle patterns **. This pattern is characterized by a price drop followed by a gradual recovery, forming a U-shape the cup, and then a small pullback the handle. This is a bullish continuation pattern, and range charts can help you clearly see the formation of the cup and handle without the distractions caused by minor fluctuations. By adding these patterns to your toolkit, such as triple tops and bottoms, wedge patterns, rectangles, and cup and handle formations, you can improve your analysis and trading decisions. Each of these patterns provides a clue about the market's next move, and recognizing them on range charts will give you a significant edge. Are you getting curious yet? There is more to come. Let us dive into our first trading strategy using range charts, and this one is called breakout trading. With this strategy, we are looking for the price to break above a resistance level or drop below a support level. Range charts make it easier to see these levels, which means you can spot potential breakouts much more easily. The entry point for a trade is when the price moves above a strong resistance or below a support level. Once that happens, you will want to make sure that several bars have closed beyond that point, so you know it is not a false breakout. Place your stop loss just below the breakout level if you are buying, or just above it if you are selling. And always set a profit target. Ideally, your target should be at the next significant support or resistance level. Our next strategy is called trend following, and it is all about moving with the direction of the market. Range charts make trends more obvious, which makes them great for this kind of strategy. If the market is trending upward, you will want to enter a trade when the price bounces off a support level and continues moving upward. One important pattern to look for here is the ascending trend line where the price consistently makes higher lows, indicating strong buying interest. Similarly, in a downward trend, you want to enter a trade when the price pulls back to a resistance level and starts moving down again. In this case, look for a descending trend line where the price is making lower highs, showing consistent selling pressure. Range charts help make these trend lines clear and easy to draw, which gives you confidence in the trend's direction. Another key pattern to pay attention to when following trends is the channel pattern ***. Channels are formed when the price moves between two parallel trend lines, either upward or downward. An ascending channel is formed when the price is moving higher between two parallel lines, while a descending channel is formed when the price is trending lower between two lines. You can use these channels to identify entry points when the price bounces off the lower line in an ascending channel or the upper line in a descending channel. Channels also provide clear places to set stop losses and profit targets. Your stop loss should be placed just below the recent support in an uptrend or just above the recent resistance in a downtrend. You can also use the lower boundary of a channel as a stop loss level in an uptrend or the upper boundary in a downtrend. The secret to this strategy is letting the trend run. Let the trend keep moving and adjust your stop loss as it goes to lock in profits while protecting yourself from reversals. This technique is often called a trailing stop and it is essential for maximizing gains while minimizing risk. Another pattern to consider in trend following is the pullback pattern During a trend, the price does not move in a straight line. Instead, it pulls back periodically before continuing in the trend's direction. These pullbacks are opportunities to enter the market at a better price. Look for the price to pull back to a support level in an uptrend or a resistance level in a downtrend. Range charts make these pullbacks easier to identify because they filter out minor price movements, allowing you to focus only on significant changes. By identifying these pullback opportunities, you can enter trades with a better risk to reward ratio. Range charts also make it easier to spot consolidation patterns within trends, such as flags or rectangles These patterns represent brief pauses in the trend before it resumes. For example, after a strong move upward, the price may form a flag pattern that slopes slightly downward, indicating a short-term consolidation. Once the price breaks out of the flag, the trend is likely to continue. Understanding these consolidation patterns can help you stay in trades longer and avoid exiting prematurely during temporary pauses. If you are more interested in shorter-term trades, then this next strategy might be perfect for you. It is called scalping with range charts. Scalping is about making quick trades based on small price movements. You are looking for the price to bounce off key levels like support or resistance, and then exit after a few bars. The goal is to make small but consistent gains throughout the trading session. To do this effectively, you want to use a smaller range size so you can see those quick moves and take advantage of them. This kind of trading can be fast-paced, but when done well, it can be a great way to build up your account over time. Before we move on, let us talk about risk management because it is super important. One of the biggest benefits of using range charts is that support and resistance levels are much clearer. That makes it easier to set your stop losses and manage your trades effectively. Always make sure to place your stop loss below support if you are buying, or above resistance if you are selling. This ensures that if the trade does not work out, your losses are limited. You will also need to consider your position size. If you are using a larger range size, you might need to use a wider stop loss, which means reducing your position size to maintain appropriate risk management. Position sizing is crucial to ensure that your potential loss stays within your risk tolerance, regardless of the range you are using. For those of you who are following trends, trailing stops are an effective way to lock in your gains as the price moves in your favor. Trailing stops allow you to stay in the trade while the market is moving in the desired direction, and they automatically adjust to protect your profits as the trend progresses. Another key risk management technique is using *** risk to reward ratios ***. This involves setting your profit target at a level that is at least 2 or 3 times greater than your risk. For instance, if you are risking $1 on a trade, aim for a profit of at least $2 or $3. This ensures that even if some trades do not work out, the profitable ones can more than compensate for the losses. Range charts make it easier to identify clear profit targets by highlighting support and resistance levels that are logical points to take profit. You should also consider using ** diversification * in your trades. Avoid putting all your risk into a single trade or asset. Instead, spread your trades across different assets that do not have a high correlation. This helps to balance your risk and reduces the chance of large losses if one trade does not work out. Range charts can help you identify good opportunities across multiple markets, making it easier to diversify effectively. Finally, keep an eye on ** market conditions ***. Different market conditions require different risk management strategies. During highly volatile periods, it might make sense to reduce your position size or use a larger range to filter out noise. In calmer markets, you can adjust accordingly. Understanding when to be more aggressive and when to be more cautious is key to long-term trading success. Effective risk management, combined with a clear understanding of range chart patterns, will give you the confidence to execute trades while keeping potential losses in check. Another way to make your analysis even better is by combining range charts with other indicators. You can use moving averages to confirm trends. For example, if the price is above the moving average, it often means the trend is still strong. Another great indicator to use is the relative strength index, which helps you see if the price is overbought or oversold. This can signal that a reversal might be coming soon. Volume indicators are also useful because they help you see whether a price move has strong buying or selling behind it. Strong volume can confirm a breakout, while weak volume might suggest a false move. It is all about getting as much information as you can to make better decisions. Let us go over a few practical tips to help you get the most out of trading with range charts. First, do not be afraid to try out different range sizes. A smaller range will show more detail, but it might also produce more noise. A larger range will focus on bigger moves, which can help you see the big picture more clearly. Range charts are especially good for trending markets and for spotting breakouts. One important chart pattern to look for on range charts is the ascending triangle **, which forms when there is a rising support level and a flat resistance level. This pattern often signals a breakout to the upside, as buyers are consistently pushing the price higher. The clearer formation of this pattern on range charts can help you anticipate breakouts and enter trades at the right moment. Similarly, descending triangle ** forms with a horizontal support level and a declining resistance level, signaling a potential breakout to the downside. Understanding and recognizing these triangles can give you an advantage when looking for breakout opportunities. Another key chart pattern to utilize is the ** rounding bottom **. This pattern represents a gradual shift from a downtrend to an uptrend and looks like a rounded bowl. It often indicates the beginning of a longer upward move. On a range chart, the rounding bottom is much easier to identify due to the absence of minor price fluctuations that can obscure the pattern on time-based charts. When you see a rounding bottom form, it could be a good opportunity to prepare for a long trade. You should also be on the lookout for ** broadening formations **, which occur when the price action creates higher highs and lower lows, forming an expanding pattern. This can indicate increased volatility and uncertainty, but it can also provide breakout opportunities. Range charts help make these formations more apparent by focusing solely on significant price moves, which can allow you to react more decisively. Finally, watch for ** diamond patterns **, which are less common but very powerful. A diamond pattern typically starts as a broadening formation and then contracts, forming a shape that looks like a diamond. This pattern can signal a potential reversal in the trend, and its unique shape stands out more clearly on range charts. Identifying this pattern can help you anticipate significant changes in market direction. In a market that is not moving much, range charts might create too much noise, so be careful about when you use them. And remember, range charts are an amazing tool for filtering out unnecessary information, but it is always helpful to combine them with time-based charts for a more complete view of what is happening. There are some common mistakes that traders make when using range charts, and I want to help you avoid them. One of the biggest mistakes is overtrading. Just because you see many signals does not mean you should take every single trade. Focus on the best setups, the ones that have strong trends or clear breakout levels. Another mistake is choosing the wrong range size. If the range is too small, it can produce too many signals, leading to overtrading and unnecessary losses. If the range is too large, you may miss important entry points, as the chart will focus on broader price movements rather than capturing useful details. Always make sure your range size fits the market conditions and the volatility of the asset. Another common mistake is failing to recognize **, false breakouts **. Not all breakouts lead to sustained trends, and it is crucial to confirm a breakout before placing a trade. Range charts can help filter noise, but it is still important to watch for confirmation by waiting for multiple bars to close beyond a support or resistance level. This can help avoid getting caught in a false move that quickly reverses. Traders also tend to overlook the significance of divergence when using range charts. Divergence occurs when the price is making new highs or lows, but an indicator like the Relative Strength Index RSI or Moving Average Divergence MACD is not confirming this movement. Recognizing divergence can be a key signal that a trend is losing strength and a reversal might be imminent. Incorporating divergence analysis into your range chart trading can help you make more informed decisions. Another mistake to avoid is ignoring key chart patterns such as double tops, double bottoms, triangles, and wedges. These patterns often provide excellent signals for entries and exits. Range charts simplify these patterns, making them easier to identify, but it is still up to the trader to recognize and act on these signals appropriately. Finally, do not ignore what the broader market is doing. Range charts work best when the market is trending. If the market is flat and going nowhere, you might get false signals, which can lead to losing trades. Always look at the bigger picture and consider the overall trend across multiple time frames before relying solely on range charts. This will help ensure that you are trading in alignment with the broader market conditions, reducing the likelihood of false signals and improving the overall quality of your trades. To wrap things up, remember that range charts are all about price action. They are great for breakout trading, trend following, and even scalping. Start by picking an appropriate range size, look for the key support and resistance levels, and combine your range chart with other indicators to improve your analysis. It takes practice, but once you get the hang of it, range charts can help you find clear trading opportunities and take your skills to the next level. Thank you for joining me on this journey into range chart trading. I hope you found this helpful. Do you have questions, comments, or any thoughts on what you would like to learn more about? I would love to hear from you. Keep practicing, stay focused, and soon you will be using these techniques to make better, more confident trading decisions.